Hey, everybody. Welcome to our Sunday Notes live show. Great to see everybody. Happy Sunday evening. Hope everyone's had a great weekend. And as we do now each and every Sunday at 6 p.m. to 6:30, we go through some of the main points for the upcoming week. We go through some of the points that I have shared on the notes. So if you're a member of the options room, the futures room, or my Sector Secrets Mastery, I've already alerted those notes, that note link out. So you'll be able to check out some of what I've got my eye on this week. This week is pretty straightforward. And that is the fact that we have the FOMC on Wednesday. We have non-farm payroll on Friday. And even though some of the other data-related hot zones are the ISM manufacturing, JOLTS, we've got ISM services. The whole week is all about that FOMC event on May 4. So that leading into Friday's non-farm payroll, these are two major macroeconomic pillars by way of what the FOMC is going to do with rates, quarter point versus half point. More importantly, at this point, what's the messaging around the rate hike going to be? And are we going to prepare ourselves for a quarter or half point hike in June? And really, what can we expect through the rest of the year? Every one of these meetings and the statement and the pressers just set up expectations for the higher rates to come. So, that's really where the focus is. So check those notes out. If you have any questions, feel free to type them in. But that is really what we're looking at. I also pointed out a couple of corners of the market that I have my eye on. What we do in these notes is not break down every single sector or put together some ginormous list of stocks. What I do, and what we do in this discussion is really focus in on what are those specific sectors, what are those specific corners of the market that I'm going to have my eye on. And if you'll notice, you'll see that the NASDAQ has just freshly gone double. You'll take a look here. It's just freshly gone double red. It's a brand new downtrend. Just really flirting with that double red there. The S&P is still neutral, but when you take a look at what happened with healthcare and financials, if those two sectors continue to move lower, it's going to be pretty much inevitable that the S&P follows suit. But where are we to look? And you'll notice I point out a couple trends, one up and a couple that are down. And that's where not only do I have continued exposure, but we're going to continue to look for buy the dips in a very specific sector and sell the rips in others. So check out what I've pointed out, because, any kind of newsletter, any kind of notes, any kind of report, and I call this Sunday the Raghee report because, well, I love alliteration. But when I'm putting out something like this, I don't want to talk about all the sectors, and I don't want to talk about 70 different stocks. I want to narrow things down to 2, 3, 4 sectors, to maybe 24 stocks that are related to those sectors. And then that gives us where the focus will be for the upcoming week. We want to be really, really specific, really focused about it. So with that being said, let's go ahead and jump into the questions, because as always, that is what our shows are all about. And first, kicking it off with Alan. Let's see, do I think we might spend some more time in the garden this week, maybe with the exception of currency movement? Yeah, are we going to be a little less active? Whenever we have major events, these huge caution events, and that's anything that we have with Powell in play, we're going to be a lot more choosy, and it's going to make a lot more sense not to be pre-positioned, but rather to take advantage of the post. And Alan, I did skim over your email before we started the show, and I think it was the one about the dollar and about currencies, and I agree. In the aftermath of Powell, if there are opportunities to get short again, the euro, 6E, FXE, Euro US, whichever path you want, choose your own adventure, I'm game. We can also add to that the yen. We can also add to that the pound, those three currencies. And because the yen, the pound, and the euro are always, where the focus is going to be if we're looking at the dollar basket, DX, UUP, The dollar index is specifically, and I'll even say only, in play when we have opportunities to take advantage of the weakness in those three currencies, euro, pound, yen, or the strength in those three currencies, euro, pound, yen, because that is the bulk of your weighting within the UUP, within the dollar index future. So we've got to think about that basket weighting. So I do like the idea of being a little bit more cautious, of course, with the kind of data, the kind of events we've got. I mean, this is a really hot zone heavy week. Not so much with earnings, not so much with earnings hot zones, but with data, with FOMC, two major macroeconomic pillars with jobs and monetary policy. It's intense for sure. And it makes sense to, as you said, spend some time in the garden or shorten the time frame up and focus on some near term, likely volatility oriented day trades. So it's going to make a lot of sense to key up, say, the 5-minute time frame and ask ourselves, all right, where are those volatility setups that we can take advantage of and play some of these volatility ranges? So yeah, some interesting stuff coming up as far as opportunities to manage a week like this. All right, next up, and thanks, Alan. BTI asked, what are my thoughts on Johnson & Johnson for a long call at the 180? So far, so good. June 22nd. Is that where the, let's see, Johnson & Johnson, June 22nd, June 17. Yeah, I have no problem with that whatsoever. I do like it. It's a double green by the dip. I'm with you on that one. Just June 17. I'm trying to think of, I don't know that even July's pretty liquid too. You go from June 17 or July 15, either one will be good. I'm with you, BTI. Good eye. I like it. I like it a lot. Good stuff. By the dip, focus on the double greens. And I think there are a handful of double greens in that XLV. So even though the XLV is moving lower, all I will add to that, my friend, is if you take a look at XLV and you look at the fact that this thing just really took a pretty significant tumble through the 200 exponential, you see there's just a handful of double greens. Be careful, but I do like focusing on that outperformer. Good stuff. Really good stuff. All right, next up, Mark asks, seems like most stocks are falling after earnings. Is this consistent with bear market, or should we have many puts to make profits? Mark, I don't ever like to talk in generalizations, my friend. We want to be specific to which sectors are already in downtrends, which stocks are already in downtrends, because it's those trends that set up the 642. So if we're looking at the tech stocks that came out last week, a lot of them were already in double reds. So remember, that tumble into and post earnings is just a 642 window that I try to focus on. If we have rips into the wave, then yeah, we have a setup. If we don't have a setup. So I'm not going to just have puts in the market unless, of course, there's a setup, right? And double red sets it up. Heading lower is not the setup. Heading higher into resistance to give us an opportunity to take advantage of the re-engagement to the downside would definitely be the way I would continue to focus on that. All right, next up, Michael asks, what are my thoughts on KO? Well, think about where KO is hanging out, first of all. So if we, and this is one of the sectors that I pointed out in the notes. So if we go to XLP, and we start to look at what's heavily weighted within XLP. And you'll notice their number 3 and a double green is Coke. So kind of going back to Mark's question, remember, we have a number of earnings windows that are starting to, that are starting to close because we've got earnings in the rear view. But just as if we're trying to set up puts for downtrends, we need a rip. Well, of course, the same thing is true going into earnings. Say Walmart, that's the 642 window approach. Double red, double green, either long puts on dips into earnings and get flat before the release. So that kind of goes back to the earlier question too that Mark had. I'm not going to take puts through earnings. I'm going to take advantage of the discounting in front of earnings, then I'm going to get flat going into earnings. I don't like to take any open position through. So keep that one in mind. We've got Coke in the rear view. So buy the dip is valid. It's KO, MO, WMT. They all look good. Keep an eye on that XLP. Keep an eye on that XLP. So I do like that corner of the market. Absolutely. All right. Next up is any comments on the Miami Grand Prix? Ronaldo, I was looking at tickets. They are crazy expensive, but I was looking at tickets. I am an F1 fan. However, you know what I figured? I get to watch it in the comfort of my home. Probably sit here in the office and watch that television behind me on a Sunday while I'm doing charts or something. But let them work the kinks out of this first race, and then we'll take a look. But I am rooting. My thoughts are the same every week. I'm rooting for Red Bull. So next up, Walmart. So yeah, Groot, I like it. And why? Well, kind of the same answer regarding the question about Coke that Michael had. And Walmart though. Let's zoom into Walmart. Let's jump into that chart. So the thing with Walmart is this. If I'm going to look at Walmart, then I need to think about how we are positioned, right, in front of earnings. And the 642 window is just about to close. It's just about to close. So if I drop a vertical line, and this is how I've always taught y'all to use the countdown to these hot zones. Just cut it back to, here we go, 2 weeks before earnings. That window is really what I want to, for the most part, avoid. So I'll just paint that red. I want to basically stop buying calls on pullbacks into the red, and then after the green, I can look at getting long again. So really what this looks like is it's red to red in that window, and then the day after we can start looking at post earnings plays. So we've got a little bit more time before we buy the dip, and then it's done. So now is, again, depending on where we open, inside the wave, supported, not bad. But remember that the window starts a month and a half out, right? So if you go 1 month out, that's 4/17. You take that other 2 weeks or so, you're basically at the beginning of April. And really the pullbacks for me are better in the uptrend with more time before the release, because remember, as we get closer and closer and closer to the release, what's going to happen is that the implied volatility is going to go up, and that's really not where we are going to generally find our edge. So that's where I say use that 642 window. But I like the bullish play on Walmart. I'm with you there. All right. Mr. Walker asks, what could be a desirable bid-ask spread in options? I won't dial it down to a specific number, Mr. Walker. What I'll say is the narrower the better. I don't want wide spreads. And then if they are wide, it's usually going to be for a couple of reasons. It's illiquid, or it's an expensive option or stock. So I don't know that there's a desirable number, but the narrower the better. That's usually my preference. All right. You like the Matrix background? Me too. Where is my Twitter? Yeah. So where's my Twitter feed? There you go. Because I believe the Matrix is a documentary. Thanks. I appreciate that. All right. What are my thoughts on a rally into Wednesday and then Judgment Day? It's interesting you ask. It depends on where. Remember, the habit that we all have to break, even me with the way I talk about the market, is not to talk about the market, right? Unless I'm just talking about the stock market or the futures market or the currency market or the crypto or the whatever. The broad generalization of the market's going to hurt us, because we need to remember that sectors are still we're seeing a lot of differences in the sectors. ITB, XHB, downtrend. NASDAQ, new downtrend. Natural gas, oil explorers are still in an uptrend. So dollar is still in an uptrend. So there are trends that are up bullish, and there's trends that are down bearish. And so I'm trying to take that verbiage, the markets, right? Because there's so many different groups, and then there's so many different trends within those groups. So when we're talking about broadly the indices are interesting. Let's take a look at the S&P. Very close to potentially turning into a downtrend, but take a look at the trend. Take a look at the multi, the flags or the multi, still neutral. Dow, still neutral. So there's a possibility for a bounce. Less so in my view, not opinion, not gut, not feeling, not hope, not wish, just structure. Red Momo, red trend, bearish multi. This is a downtrend. It's brand new. Brand new is both very vulnerable and volatile, right? The psychology hasn't had a lot of time to get set, but seeing how the previous transitions were from chop to downtrend, chop to a downtrend, this is not something new, and we'll likely see more of the lower low psychology, especially as bonds, ZN, IEF, TNX yields, the 10-year yield continue to go up. So I don't know. What are my thoughts? I try not to do that, Michael, because I don't know what the markets are going to do. I think the moment I hear anyone say, well, the markets are going to go here, and then they're going to go here, and it's going to take 3 months, I really want to know what someone like that is smoking to kid themselves into thinking that we can predict. I don't predict. I react. Gang, I'm a counterpuncher, right? If we want to use the baseball analogy that I love so much, I'm a batter at the plate. The market, stocks, options, futures, Forex, whatever, that's the pitcher. The pitcher's going to throw something. That's all I know. What they're going to throw, whether I can hit it, if it's in a spot over the plate in my zone, all those I don't know. I don't even know really when the pitcher's going to throw the ball. I just know it's going to happen. But I know that as it's coming, I have to make a decision, right? Same thing if you want to use a boxing analogy. We're all counterpunchers. We don't mount an offense against the market, I don't believe. We look at what the market does, and we react to it. So I like that counter-punching analogy. So my friend, I totally get what you're saying, because what you're doing is really smart, which is, hey, Rag, I know we've got this major hot zone on Wednesday. What do you think? Let's see if that happens, right? So what I would say, Michael, is we have this potential scenario. What would have to happen on, for example, the S&P chart for me to say there's a bounce and then therefore maybe a rally going into Wednesday? I'd have to see a pattern. I'd have to have a setup. Maybe it's the Darvis. Maybe it's my Darvis, my actual Darvis signals. Maybe it's my slow stochastic hooking back up and getting through 20. So our job is to say, when we see our setup, that's the pitch, over the plate, in the right zone, when we see that, then we can act. So until that happens, my friend, the only honest thing anybody can say, unless they've, again, deluded themselves otherwise, is when I see this, and this, then I will act, right? Whatever that checklist is, whatever that criteria is to validate the entry. Not the markets are going to go here, and this is the low, and it's going to turn around in the... No. You know what I mean? So if I ever start doing that, if I ever start playing crystal ball trader, please call the men in black. I have been abducted by aliens, right? So definitely someone help me out if that happens. If I start talking like that, call me on it, because that's just not what trading is all about. I thank you for the question. Good, great question. All right. Austin says, I'm long Johnson & Johnson, but the XLV chart is hurting. You know, I totally hear you, and that's a great way to say, Rag, I've got a long position that can stand on its own, but boy, that tide is going out. You know, this is where I'll say you've chosen the relative outperformer. Perfect. Now, just play it out. That's all we can do. Play it out. Know your volatility. Know your... well, we're going into ex-dividend date, which is not too shabby a place to be, my friend. It's usually a pretty bullish catalyst. Not parabolically bullish, but supported. Should attract buyers. So we know that Johnson & Johnson is going to have to deal with this outgoing tide, but it's got the structure to do it. It's got the ex-dividend date hot zone to do it. So we know what our validity is for the trend. It's got to preferably stay above the 34 EMA on the low. And we know what the validity is in terms of risk to our account. That's scalable mindset. It's not small, it's not medium, it's not large, it's not Godzilla-sized account. Thinking it's, have I scaled it in such a way that if I'm wrong, because that's all that matters, if that's all we can control, if I'm wrong, am I going to limit the damage to my account? And that's the market money math. That's the budgeting that we actually start off with. Probably the first video any new member of the Sector Secrets Mastery gets is my 20-minute Holy Grail video on position sizing, stop loss placement. And it's much more just about the arithmetic of your account and allowable risk than some people think. So I hear you, and great observation. Stick with the plan. Stick with the plan. I like what you've got. You know, if there's anywhere that you're going to look to take advantage of the dip, you're in a similar place that I'd be looking to, Austin. All right. Corey asks, how do you decide when to make post-earning plays on a buy the dip or short the rip chart? So Corey, really easy, really easy. There's no enticing. Volatility is going to keep me away. So imagine this. Imagine you didn't know there was any earnings. What's the chart look like? It should look like a setup. It should just still look like a setup. That's really the best way to do it. So if we have a pullback on earnings, usually I like to give it one more extra session, especially if we push the upper end of the historical volatility. That would definitely be a good reason to pause, wait for an inside day or a minor low. But if the structure is still intact after the earnings hot zone, but the same thing would go with FOMC. The same thing would go with any decision I make on non-farm payroll or initial claims or whatever the hot zone is that created that volatility. Is the trade still valid? Is the setup still there after the volatility hit the market? That's usually the first litmus test. So thanks for the question. All right, got questions on Hal. Hal got hit hard. I'm going to stay away from Hal right now. But we've got 3 Darvis levels starting at 34.25, going all the way down to 33.5 or so. Hal I'll stay away from right now. Hal's been very good to me, but not so good as of late. And Archer Daniel Midland, these are both commodity corners of the market. Commodity corners of the market have been very good to me since March into April. And then all of a sudden, we know what happened last Thursday, Friday, and then Monday. These were multi-month uptrends. Look at Archer Daniel Midland. This thing's been moving higher all year long. And in the matter of a few days, really 3 days, commodities, so you're talking your miners and your oil services and energy, a lot of these got absolutely whacked. And multi-month uptrends, those uptrends were undone in 3 sessions. So I'm definitely trying to refocus on fresh trends. Well, not even fresh. Let me take that back. I'm trying to refreshen my watch list with the trends that survived really that whole Wednesday, Thursday, Friday, even Monday of last. Well, it would have been Wednesday, Thursday, Friday of the week prior. So, and then Monday of last week, that 3-4 days, really, really tough. So what's still holding its own? What still looks good? What still has structure? And that's where I look at. That's where I look at the ITB and the XHB and the XOP and the FCGs and say, all right, who survived? So ADM is still on the list. In fact, we have an open trade in ADM. Nick asks, how do I approach risk management? The basis of my risk management approach, Nick, is the account size. Everything goes back to account size. From there, you start to do calculations on how many dollars worth of options can you buy, how much of that premium can you risk, how many positions can you have maximum and not risk ruin. That's the approach. It's the whole approach to risk management and position sizing is managing risk. And that's the way we do it. Just run some simple arithmetic and go forward with that. Do I think NASDAQ is going to bounce back north or continue? Trader Momo, I would prefer to not look at the potential for a bounce in the NAS and focus on the S&P or the Dow, because in a double red downtrend, the oversold bounce is no longer. So let me show you here. Here's the NASDAQ. Look at the red trend in the upper left-hand corner, right? Just above my head here on the screen. Now look at the S&P. In a neutral market, yellow trend, no problem. Overbought, oversold is valid. In a double red, not so much. So NASDAQ, I'd have to say no, probably not. Although I will also in the same breath say there's a chance it could be more volatile because it's a little bit more interest rate sensitive than ES and YM. But the structure of the trend tells me I'm not allowed to do that. Short the rip, yes. Oversold, buys, no. All right. Should bank and XLF be doing better in a rising rate environment? David, that's usually the assumption, right? But that's a very, assumption's very sensitive to how high are they going to go, right? So I've generally been operating from something that was taught to me about 20 years ago is banks really don't care until rates are north of about 3%. That's the same opinion that I'm holding. Just because rates are going higher doesn't mean they've crossed the threshold of where it's helpful to the banks. And even if that's something you might say, Rag, well, what is that threshold? It might be different. Here's what we know. You know what price is telling us? Price is telling us. Who knows what should be happening to ourselves? I think us traders can should all over our trades, can should all over our accounts and get into a lot of trouble. We never want to think about what should be happening. We know there's a probability. Then we want to check to see, is it? And if it's not, that's clearly then not what the market is. The market meaning this market, financials, regional banks, and market participants like you and I, David. That's clearly not what out there traders and investors are thinking. So the financials market, the regional bank, those corners of the market, they really don't seem to be benefiting. So one is an idea. Should banks and XLF and KRE and financial stocks do better in a rising rate environment? That's a hypothesis. It's a story. It's a narrative. Then we go check the narrative with price. And if it's not happening, it's not the primary driver for the way in which traders and investors are treating that corner of the market. I hope that makes sense. What are my thoughts on Lilly? What are my thoughts on Lilly? I think there's better places in the XLV to buy. At least we have the earnings in the rear view. Oversold between 238.25 and 276.5. Looks really good. You can see the slow stochastic adjustment there and the signal, right? So take a look at the low half here. We have a neutral market, so slow stochastic is valid. Got down to the 20, switched from red to green, got a signal. That's really where you want to focus on overbought, oversold. Use the Darvis, then the slow stochastic. Nothing's better. Just nothing is better. Those are both free, by the way. You can throw a slow stochastic on your chart within Thinkorswim. You can go get the Darvis 2.0 from over at countdowntrader.com. So what's not to like there? But I think there are better corners of the market within XLV. We've taken a look at them just a little bit earlier here in the show. We have, I believe it was 3 double green markets within the choppy, very weak actually, XLV. So Lilly, not bad, but not as good as the double green. What are my thoughts on TLT and ZN this week? TLT or ZB. So let's stick with the future. ZB and ZN. I'll tell you what, Mark, I would assume they're just going to keep going lower. And if for whatever reason the Federal Reserve sounds a little less hawkish and we get a rip higher in ZN or ZB, helping us out in IEF, helping us out in TLT, I'll get long puts in the rip higher. That's short the rip. Or I'll actually short the ZB and the ZN on the short the rip. So that's my thought. Can Powell give us an opportunity, a reason, a setup up to those levels that we'd like to build that position in? That's the whole thing. All right. So next up is, all right. Am I bullish DBA? I am. So it's still within the wave, right? It's still within the wave. It's neutral. It's not as bullish as when it was double green. We bought DBA on dips before. I still like it. It's really more of a commodity setup. again, commodities have gotten hit hard. DBA was able to survive a lot of those hits that took out steel and miners and hit GDX really hard, hit a number of oil stocks and oil corners of the market really hard. But commodities are holding their own. Natural gas is also holding its own. So I'm still bullish DBA. Now, remember, if you scaled in, as I teach in Sector Secrets Mastery, and say your agro is no longer valid, get out. You know what your premium risk is, right? You know what your premium risk is. And if at any time an individual leg of an overall position has gone beyond its allowable risk, gang, it's not personal, just get out, right? Just trim that aggro leg of the overall position. You can have the moderate, you can have the conservative. Heck, if we get down to the moderate, if we get down to the conservative, those are still valid trades to put on. And that's what I think is really important, that we're as comfortable scaling in as scaling out. All right. Okay, so on the SlowStow, am I displaying K or D? So the easiest thing to do on the SlowStow to kind of clean it up, if you want the D and the K, you can absolutely do that, right? Or you can trim it out. Now, I've actually got a couple different things overlapped here on my SlowStow. I think I'm running my sector SlowStow. So let me show you that. And you'll see I've got the K running, right? So that's the way we do it there. But what you're seeing is the D. Is that, if that's what you're asking, what am I seeing on my screen? The D. That is the D you're seeing on my SlowStow or my sector SlowStow. And the only difference is not a setting difference. It's still 21K 3D. If you're my Sector Secrets Mastery, you get the prettier color-coded version. If not, go into Thinkorswim, grab their Slow Stochastic 21K 3D 80/20, turn on both the K and D signals. It's a fantastic choppy market tool, and you'll get the crossing. If you don't want the crossing, just keep the D on there. That's fine. That's fine. All right. They will signal the exact same way. This just helps my very nearsighted eyes see those crosses better with the color change rather than the lines. Okay. All right, gang, we are out of time. But as always, thank you so much. And joining me for Charts and Coffee, our 30-minute show every Sunday from 6 to 6:30. I appreciate the time. Check out the notes back at the Simpler Trading membership for options, futures, and my Sector Secrets Mastery. I will see you all right back here at the Simpler Trading YouTube channel at 9 a.m. tomorrow for Charts and Coffee. Be good to each other, gang. I'll talk with you soon.